After learning about the structure of securities markets in our previous module, we would now move on to learn about key terminologies in financial markets. Knowing the meaning of these terminologies will help you understand valuation in a better manner, as well as understand the effects of capital market operations. To easily make you understand this module, we have divided it into two sections. The first section is of valuation-based terminologies, where we would be covering terms like face value, book value, replacement value, and enterprise value. The second section is of capital market operations-oriented terminologies, where we would be covering stock splits, share consolidation, and buyback of shares. We will now move on to understanding valuation-based terminologies. The first terminology that we will cover here is that of face value. Face value of a share is the nominal price of that share as stated by the issuing company. Face value is not the market price of the share. However, knowing the face value is really helpful in interpreting as well as determining the market price of that share. Commonly, companies issue shares with the face value of either rupee 1 or rupees 10. To understand this more in detail, let us assume the case of two companies, ABC Limited and XYZ Limited. Imagine that ABC Limited wants to raise around 50 lakhs from the stock market. Do note that in this example, we will be assuming that the face value of a share is equal to its market price. But now, when ABC Limited looks to raise 50 lakh from the stock market, it does this by issuing 5 lakh shares of rupees 10 as the face value. Let's take a parallel example. XYZ Limited is looking to raise 50 lakh from the stock market. In this case, it issues around 50 lakh shares of rupee 1 each. Both companies successfully raise the same amount, which is 50 lakh from the stock market, by issuing shares of face value rupees 10 as well as rupee 1. Recall that the valuation or market capitalization of a company is equal to price and into outstanding shares. In this case, both ABC Limited and XYZ Limited have the same market capitalization of around 50 lakh. However, the method with which they attained this market capitalization is different. Now let's continue this case. In event of the share price of ABC Limited going from rupees 10 to rupees 50, and the share price of XYZ Limited going from rupee 1 to rupees 6, XYZ Limited will be the company that has delivered better returns. Therefore, the knowledge of face value is highly important in gauging the amount of returns that a company has delivered over time. The next terminology that we are going to cover is the book value or total net worth of a company. The book value or total net worth of a company is arrived by selling its assets and settling its liabilities. Therefore, book value or total net worth is equal to total assets minus total liabilities. Now, all companies need not actually sell these assets and settle these liabilities to get to the total net worth. In lot of cases, it is assumed as the value of its total assets and the value of its outstanding liabilities. It's important to note that the value of assets and liabilities while calculating net worth is taken at historic prices. Therefore, if land is purchased at around 25 lakh in 2010, while calculating its net worth, the company will take 25 lakh as part of its assets. This does not account for the price inflation that has happened over time and other considerations due to which the price of that land could have changed. Companies can, however, opt for periodic revaluation of its assets, where the assets get valued as per market conditions and price inflation. It's important to note that book value and market value are two different concepts. Book value is determined solely by a company's net worth. However, market value is determined by a host and a variety of factors as discussed in modules earlier. The next terminology that we are going to cover is replacement value. Replacement value of a company's assets refers to the value of the company's assets in today's current market price. Therefore, replacement value essentially means the amount of expenditure that the company would have to make if it went out and purchased these assets in today's pricing. Factors like inflation often drive up the value of a company's historical assets, and therefore this makes replacement value a critical concept. Let's continue the same example that we used in the earlier terminology of book value. Land purchased in 2010 for 25 lakh can be worth 2.5 crores today in 2019 simply due to inflation and other market considerations that have driven up the price of this land. Therefore, the replacement value of land would be 2.5 crores, while the book value of the same land could be 25 lakhs. Now, let us move on to the next terminology, which is enterprise value. Enterprise value of a company is arrived by adding its total equity and total debt and then going on to reducing its cash reserves from this sum total. Therefore, enterprise value is the value of a company's equity, which is determined by the company's market capitalization, the company's debt, which is determined by both short-term as well as long-term borrowing. These two values are added together. Then cash reserves of a company are deducted from this value to arrive at the enterprise value of a company. Enterprise value is a more robust valuation parameter than market capitalization and is often used in mergers and acquisitions. This is because during a merger or an acquisition, when company A acquires company B, it not only acquires the equity of that company, but also takes on the liability or the debt that is associated with that company. To repay company B's outstanding debt amount, company A can take help from the cash reserves of company B. This is the primary reason why the cash reserves are deducted from the sum of equity and debt to arrive at the company's enterprise value. After covering valuation-based terminologies, let's now shift our focus to capital market operations-oriented terminologies. In capital market operations oriented terminology, the first terminology that we will be studying is that of a share split. A split occurs when a company issues additional shares to existing shareholders in a specified ratio in order to increase the number of shares outstanding in the market. For example, in a 2-for-1 stock split, you as a shareholder would get 1 share for 1 share held by you before the split. To make this clearer, before the split, if you owned 100 shares of a company, after the split, you would be holding around 200 shares of the same company. Before the split, if the face value of your share was rupees 10, after the split, the face value of your share would be rupees 5. Before the split, if the market price of your share was rupees 20, after the split, the market price of each of your share would be rupees 10. As we can see, the number of shares that you hold doubles while the price of each share becomes half in this particular case. This leaves the total value of your holdings unchanged in the event of a stock split. A split is usually done by a company in order to make its shares more affordable for small investors. The next terminology that we would cover here is share consolidation. Share consolidation is exactly the opposite of a share or a stock split. A share consolidation occurs when the company consolidates its shares in the hands of existing shareholders in order to decrease the number of shares outstanding in the market. For example, in a 1:2 consolidation, you would get 1 share for 2 shares held by you pre-consolidation. For example, if you held 200 shares of a company pre-consolidation, you would be holding 100 shares of that company post-consolidation. If the face value of each share was rupees 5 pre-consolidation, the face value of each share would be rupees 10 post-consolidation. The market value of the share would also similarly double post-consolidation. As the market price of the share doubles and the number of shares held by you becomes half, the market capitalization as well as the total valuation of your holdings would remain same. The last terminology that we are going to cover in this module is the buyback of shares. Buyback of shares is done when a company purchases shares from its existing shareholders via the stock market. To understand this more in detail, let's take the example of ABC Limited, which has around 1 lakh shares outstanding in the market at a market price of 50 each. It can announce or come up with a buyback offer of 20,000 shares at rupees 60. As an investor, you have the right to opt in for this buyback. If you opt in for this buyback, your shares would be purchased back by the company in the proportion of shares currently held by you. Similar to the case of rights, if 2 investors both opt in for this buyback, the investor with greater number of shares before the buyback will have more of his shares purchased back by the company in the buyback offer. It's important to note that a buyback offer is often done on a premium to the prevailing market price. As we can see, even in this example, the buyback was announced at rupees 60 when the market price was rupees 50. Buyback is often done by companies with the primary objective of gaining back control in its shareholding pattern. Do keep these terminologies in mind as we move forward in this program and go towards modules that cover valuation as well as fundamental and technical analysis.